Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. Welcome to Bazaar Morning Call. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I am Reema Tendulkar. With me are Nigel and Mangalam. Hi guys, an extremely exciting, nail-biting match to watch. That's on one side, and then on the other hand, you've got disappointing market cues.
Totally. You know, the one thing that was great was the game yesterday. In that as well, there were moments of serious nervousness, the way Bettel played, etc. Both Nigel and I were at the stadium. Incredible atmosphere. While we were at the stadium, whatever network we got, we were also looking at updates coming in from global markets. And like you said, you know, 250-point decline from the GIFT Nifty.
You know, it got a little too close for comfort, actually. Happy that India pulled it through. And I think now the cup is ours. I think now we've got the momentum with the kind of win that we had. And obviously, I'm an optimist, right? So I expect that. But Mangalam, I think you'll concur with me. You know, when Team India was down, when we had a phase when, in fact, it looked like the English are fighting back, that's when the crowd, the Wankhede crowd comes in there. And that's the 12th man on the pitch. The cheering, you know, the Team India, India, India. You know, and that's what set the atmosphere again. And we got a wicket immediately after that. You know, they reached out to the crowd backed them up in full power. And what an electrifying atmosphere. A little bit of goosebumps even now.
Thrilling. It was
thrilling.
Absolutely thrilling.
These are moments that you know, you can only say that you were there and you experienced them. It's something that cannot be explained in words. But we have a market to contend with. Off Sunday, I will keep my mouth shut because I don't want to jinx it.
You don't want to jinx it? Well, when it comes to markets, it's a risk-off Friday morning. Dow slumped 800 points, ended 1.6% lower. The S&P 500 closing about 0.6% down, while the Nasdaq Composite was lower by 0.3%. Markets were down, oil prices up. Brent crude made an intraday high of 86.3, against per barrel. Now it's come down to levels of about 84.5. WTI crude had touched 81, and now again that too has eased. But just to put it in context, before the outbreak of the war, Brent crude was about $72, $73 per barrel, which means in a span of 1 week, we've seen a surge of 15%. For India, there is a bit of a relief as US has issued a temporary 30-day waiver to allow Indian refiners to purchase Russian oil. Treasury Secretary Scott Bessent said President Trump's energy agenda has resulted in the oil and gas production reaching the highest levels ever recorded. To enable oil to keep flowing into the global markets, the Treasury Department is issuing a temporary 30-day waiver to allow Indian refiners to purchase Russian oil. That tweet will also come up, and we'll talk more about it. No new direct Trump posts on Truth Social or X, but statements from Donald Trump via telephone interviews to Reuters, Axios or White House events, where he said the need to be personally involved in selecting Iran's new leader. The son, is most likely to be the successor, but the outcome is unacceptable to the U.S., asking Iranian diplomats and the IRGC, the Iranian Revolutionary Guard, to defect and seek asylum. But that said, the war continues to drag on. Today would be day 7, and the U.S. Central Command has said over 200 Iranian targets have been hit in the last 72 hours. You know, yesterday in the markets, there was a brief excitement. In the last hour, we had a 300-point surge in the markets on hopes of de-escalation. But the latest statements seem to suggest no truce or thaw. The Iranian Foreign Minister, Abbas Araghchi, said to NBC News, "We're not seeking a ceasefire from U.S. and Israel. Do not see any reason why we should negotiate." And he went on to say that if the U.S. military invades Iran, ground forces, it will be a big disaster for them. For the Indian markets broadly, yesterday we did see a relief rally. So after 3 days of heavy selling, yesterday the Nifty closed up with a gain of about 285 points. But despite that, the Nifty, the benchmark index, is down 1.6% so far this week. The mid-cap index and small-cap index down 2.3%. Banks have been struggling. The Nifty banking index down 2.5%. This morning, the GIFT Nifty is suggesting a downtick of about 250 odd points. But at one point, when the Dow was down 1,100 points, we had the GIFT Nifty lower by even 400 points. Short-term supports for the market will be closer to Wednesday's panic low of 24,300. So that is an important marker, 24,300. That is Wednesday's panic low. The high yesterday was 24,854. So if you have a gap down opening, that will be the immediate resistance to conquer. And thereafter, 25,000 to 25,100. But Nigel, another day and big FI selling.
Well, that's right. The cues actually are stacked in favor of risk-off trade. But hopes of de-escalation, that's what will keep the bulls a little bit interested, that hopefully over the weekend you hear some kind of talk with regard to de-escalation. As Rima mentioned, yes, the institutions, they were buyers yesterday because the DI inflows, they outweighed the FI selling. And the FIs have been selling for the last many trading sessions. The only positive yesterday was that the FI selling was relatively low in comparison to the previous couple of trading sessions. Well, the FIs in the index futures, they added more longs than shorts after a while, though their short positions hold at around 85% or thereabouts, while there has been some lightening of positions on stock futures. Both on the long as well as on the short side, there was some lightening of positions. On the options space, the FIs went ahead. They wrote more calls than put on the index options itself. So, if you're looking at a couple of strikes where they were writing, well, the 24,800 call. There was some writing that was seen out there. 24,600 put as well. There was some writing out there. And just look at the options data, you get a bit of a range, the near-term range on the Nifty. So punching in this options data, looking at the technicals as well, it appears the recent low at around 24,300, that's the demand zone to go long. While resistance comes in at around the 25,080. I say 25,080 because that's a 38% retracement of the recent fall from around the 26,000 mark all the way to around the 24,300 or thereabouts. So this 25,080 is a very, very crucial resistance mark that you're looking at. The Nifty Bank, well, that's trying to make its move gradually back towards that 60,000 odd mark. But the fear is that it could slide and maybe visit the 200 DMA, which in turn will put pressure on the market. But I'll tell you what, this is a very, very strong support zone. On the upside, this 100 DMA has been a bit of a resistance zone in the last few trading sessions. Well, I think it's getting the war is getting a little too elongated for comfort, and hope that there is some kind of de-escalation, some kind of resolution, because now, the markets, we're already a few trading sessions into this war. Sometime next week, you want this to subside, and for the good of humanity, for the good of the markets as well, this needs to wrap up in the next couple of trading sessions. Otherwise, it could get rather painful for Indian equities as well.
Take that point, Nigel. Thank you for that. It could get painful for Indian equities if this extends. So we'll monitor the extent to which this war continues. But on the equities itself, Lawrence Blanco this morning, he obviously of CLSA says that this week's price action across risk assets appears to reflect a positioning-driven correction, degrossing rather than a synchronized risk-off sell-off that would normally be expected given the evolving situation in the West Asia. The best-case scenario, as per him, would be headlines pointing to de-escalation in the West Asia mark or into or over the weekend, which would support the view that a week's pullback, largely a retracement to the 50-day moving average across leadership sectors and markets, has already formed a near-term low. He also adds that a clear risk, however, is that an escalation in the conflict triggers a broader synchronized risk-off move in the coming sessions, potentially culminating into a capitulation low.
And on the Nifty, Lawrence Blanco says this week's weakness has taken the Nifty back towards support provided by early February lows. That coincides with the May, June, August, September 2025 lows of 24,300 to 24,500. Just below this shelf of support is the upper boundary of the February and April double bottom pattern at 23,700 to 23,800. In the near term, further ranging action between 24,300 to 24,500 on the way down to 26,277 to 26,341 is expected. A break below 23,700, 23,800 support zone would be a negative event, as such a move would negate the outline of the cup and handle consolidation pattern.
Right, and in some relief for the oil sector, the US Treasury Department has announced a temporary 30-day waiver to allow Indian refiners to purchase Russian oil. US Treasury Secretary Scott Bessent said that the move was in light of the oil and gas production reaching the highest levels ever recorded. He added that the measure will not provide significant financial benefit to Russian government, as it only authorizes transactions involving oil already stranded at sea. India is an essential partner of the US and they fully anticipate that New Delhi will ramp up purchases of US oil. This stopgap measure will alleviate pressure caused by Iran's attempt to take global energy hostage. Right, with that, let's welcome Cameron Brandt, who's the Director of Research at EPFR Global, who joins in. Cameron, good morning. This kind of, uncertainty that we're seeing, what does it do to your, thesis on the flows? Where do they go from here on? Because one, the developed markets, the US obviously is, involved in this uncertainty, geopolitical uncertainty. Alongside that, there is stuff around the tariff and AI trade as well. But because of this geopolitical uncertainty, flows move away from emerging markets as well. So, I mean, it's not safe on either side of the spectrum right now.
I think that's a very fair analysis. Certainly what we've been seeing on the fund flow picture is a slightly muted risk-off response. We've seen solid but not out extraordinary redemptions from US equity funds. We didn't see any meaningful flows to physical gold funds this week, which did surprise me a little. And the response in the emerging market space, diversified funds continue to see money. There was some sort of catch-up flows into dedicated China equity funds. But I think overall, conflict with Iran is not a new phenomenon, though this is obviously a much more intense cycle. And I think certainly in the mutual fund space, investors to use it know that acting too precipitously tends to have costs. If you overreact, you get to repent at leisure as markets rebound.
But broadly, Cameron, on account of the geopolitical uncertainty, are we seeing reduced interest in equities, whether it's emerging markets or developed markets? Because there literally seems no place to hide. Everything's been, everything is sold off. As you said, it's a muted risk-off as of now. It's not that we're seeing deep gashes. But generally, in terms of equity flows, what have we seen from the beginning of the war? Oops. Okay, we'll try and reconnect with Cameron to get a sense of whether we have seen generally a risk aversion towards equities. So unless someone's a compulsive, long-only investor who has to stay invested in equities, other than that, what else is happening? Because, otherwise, are investors still interested in equity markets? That remains the big question. That's the picture on Wall Street overnight. Let's also tell our viewers in the meanwhile the interactions that we've lined up on the show. So first up, 8:35, we'll bring you a conversation with the management of HUL on their India opportunity. 9 a.m. we have Prashant Biani of Elara Securities to focus on the fertilizer space. 9:20, Gautam Trivedi of Nepean Capital will be the market master for the day. 9:35, the management of Fractal Analytics will join in to talk about their Q3 FY26 numbers and the outlook going forward. Following that, the management of Equis will be joining us at 9:45. Towards the end of the show, Lata will be discussing the changed contours for the Indian oil and gas companies with former CMD of GAIL, S.K. Gupta, and former CMD of BPCL, Krishna Kumar, on today's It's the Economy. All right, we'll slip into a break on that note. On the other side, we'll drill it down to individual stocks. CNBC TV18's list of top stocks lined up next. Welcome back. Actually, the picture across Asia is not too bad. You've got the Kospi, which is down 1%, but that follows a fantastic rebound that it had in the prior session on Thursday when Kospi closed out with a double-digit gain. So you've got some weakness coming through in Korea, but the other markets are holding up in the green, whether it's Hang Seng with a 1% up move, the Taiwanese markets are higher by nearly a third of a percentage point, and the Japanese market too has a gain of close to about 0.5%. The GIFT Nifty, though, the implied open is suggesting a gap down opening to the tune of about 200 odd points. Cameron Brandt of EPFR Global is now back with us. Cameron, we were just trying to assess that from the beginning of the war, generally have we seen risk aversion towards equities on the whole, whether it's the US markets or the emerging markets? are we seeing, if not outflows, the pace of inflows come down? And is there any data backing that?
Yeah, so to answer your question, there were already quite a few headwinds building even before the war, and the war was actually pretty well flagged. So we'd been seeing a definite rotation towards the big diversified fund groups, but overall flows had been actually holding up pretty well, and they certainly didn't go full negative this past week. Before where people are hiding, two areas that have done quite well won't come as a surprise to you. We saw record-setting inflows this week into energy sector funds and very strong flows into defense and aerospace funds.
Not surprising, they're both energy and defense right on top at the epicenter of the conflict, and defense being on the right side in terms of price action and flows. Cameron, any particular thoughts on the flows with respect to India?
India has lagged a little bit because the other thing that still seems to provide some protection in the emerging market space is an artificial intelligence development story. I know shifts from the development to the application, but in the current climate, it's been Taiwan, China, and Korea funds dedicated to those markets that have actually managed to continue to pull in fresh money, whereas India equity funds saw modest outflows this past week.
All right, Cameron, but one would have thought that since the Indian markets didn't participate so much on the upside, markets like Kospi, Taiwan, they did much better than India, right? And that's why we have not seen those kind of reactions. Earlier this week, I recall the Kospi on one day was down 10%. So are you seeing a higher amount of outflows actually from those markets because they are the AI players? They have seen a significant run, while India, we have relatively underperformed and the FIs are underweight India. So in those terms, the outflows are more severe in those markets?
I mean, I can't argue with you. I think India is sort of shifting towards undervalued territory. But the AI technology story is dying hard, despite some real kicking of the tires we've seen in the past few weeks about what kind of return and when you'll get on massive AI investment. So, if historically, if things continue longer than I think markets are currently pricing in, India's defensive qualities will come to the fore, and there is the sort of positive valuation side that you mentioned. But right now, as I said, I think people are trying to make sure that they don't overreact and expect the conflict to wind down faster than some of the headlines might suggest, in which case the markets you mentioned will likely resume, at least for a while, their upward leg.
All right, we take that point, Cameron. Hope to have had a conversation on a better line, but we take your point on the flows, and we'll obviously continue this conversation as we move along in the days to come as well. But for now, we thank you. And let's talk about all the stocks and sectors that would be in focus today. Research team, as always, with us at this hour for CNBC-TV18's top stocks for the day. Let's start with the refiners. That will be the big story of the day, given the 30-day waiver that has come in. Sonal joins in. Sonal, good morning.
Well, yes, it is a positive news which has come by because US in an order has given 30-day waiver to India to buy Russian oil, Russian cargoes which are stuck at the sea. This is, of course, to ease supply concerns which are arising because of West Asian conflict and the tensions around that. However, it is important to note it is they can accept shipments only in transit. There is no fresh buys that can happen. So we do not know the quantity, but nevertheless, this will bring in more supply to India, and that is a positive news. So the refiners like Reliance Industries, the other oil marketing companies, they will be in focus today.
Thank you very much for that. Fractal Analytics, this is one of the recent IPOs. They're coming out with their Q3 numbers. That's December quarter ending. It's overall a good quarter. The company's top line went up by 21% year-on-year, 7% on a quarter-on-quarter basis. Q3 revenues stood at 854 crore rupees. Adjusted EBITDA, adjusted for the ESOP expenses, etc., came in at 17.8%, expanding by 40 basis points year-on-year. Gross margins for the company are at 47%. R&D spending is about 6.8% of the overall revenue, and profits have crossed the 100 crore quarterly mark for the first time ever. Profits showing a jump of about 9% on a year-on-year basis, sharper jump seen on a quarter-on-quarter basis. So on the whole, it's a good quarter. The company is growing at 20% on a year-on-year basis, 7% on a quarter-on-quarter basis. So if you compare it with the Indian IT services companies, which are showing you low to mid-single-digit kind of a revenue growth, in that context, Fractal has done well in Q3 and even in 9 months. The issue price for the company was 900, but the stock is somewhere around 750. So that's Fractal analytics for you. But Vinny is now joining in for more stocks which are in the news today.
Hi, good morning. So first up, I'll start with Dr. Reddy. Some positive news coming in here. The company has received an EIR, that's an Establishment Inspection Report, with a voluntary action indicated for its manufacturing facility in Srikakulam. This is a formulation facility for the company. Now, obviously, this is a bit of a positive news. Why? Because this means that there is no concern or major concerns that have come in this report, and the overhang that was there of this inspection going on, that goes away from the stock. So Dr. Reddy's right now will be in focus today. We're expecting some bit of a green if the market favors overall the situation. Tata Elxsi, that's another one that we'll keep an eye out on. The company has announced the launch of Dev Studio AI, which is an automotive multi-agentic solution, which is mainly to provide, will be provided for OEMs, system suppliers, as well as semiconductor companies. Some positive news there as well. And Sami Hotels, that's another one. The board has approved an acquisition of 70% stake in Rare India, which is an entry into high-margin leisure side segment as well. And this is going to be via an asset-light model. Interesting to watch out for that as well.
Thank you very much for that. Over to Manisha for more on crude sensitives.
Well, thank you so much for that. It's 2% down on the U.S. statements, really, that we have seen the crude oil prices on. But having said that, it is still 18% higher in this week till time. This is the biggest weekly gain that the crude oil prices have seen since 2022. Now, U.S. is considering various options to address the surge in oil prices. SPR is something that the U.S. president has said maybe might not go to, but granting waivers on fuel blending requirements, U.S. Treasury perhaps trading in oil futures are a couple of things that the street seems to be discussing at great length. Apart from that, even as we are into the U.S.-Israel conflict with Iran entering day 7, the markets have seen some supply disruptions come in across Bahrain, Kuwait, Qatar has stopped gas, and all of that markets believe is in the prices already. Having said that, it is the OECD countries, including China, which have huge crude oil stocks, and that perhaps could be looking at markets not reacting too much. It is also about higher crude oil prices, with the street believes, which will just about continue. Goldman Sachs, Citi, JP Morgan are talking about crude prices between $75 to $85 a barrel by the third and the fourth quarter in this year.
All right. Take that point. Thanks a lot, Manisha, for that. Let's give a quick recap of all the top stocks that we're tracking. Stocks with positive news flow. We have Reliance, IOC, BPCL, HPCL, ONGC, Oil India on the back of that relief that has come in. Fractal Analytics on their numbers, Dr. Reddy's, Tata Elxsi and Sami Hotels. While today, despite the market, no stock which is, in focus on account of negative news flow. Though, let's see how they all open. With that, we take a short break, come back on the other side, an exclusive conversation with the management of HUL on the India opportunity and more. Welcome back. You're watching us here on Bazaar Morning Call. At the Lime Season 17 Grand Finale, I caught up with HUL's MD and CEO Priya Nair to discuss India's rapidly expanding FMCG landscape. More importantly, her outlook on the country's consumption story for the next 10 years and how HUL stands to grow in that.
We can't do any story of HUL without doing a story of India, because India and HUL is strongly linked. So I think, firstly, India stands at an incredible position in the world. With our GDP growth that we are seeing as a country, we are very well poised in a world which is increasingly looking more challenged. I think India is a bright spot. So I think that's the first thing that we must remember. And in that context, the transformation of India will reflect in the transformation of HUL and consumer goods. So whether it is premiumization, really category creation, and it starts with the current per capita consumption of consumer products in India. At $54 per capita, it is significantly lower than all the neighboring peers. You think of Southeast Asia, other economies. So huge headroom to grow. And HUL as the leader of consumer products, the biggest opportunities in growing and creating categories. That's what we have done, and that's what we will continue to do. And the way you do it today is changing. It is changing in terms of the media choices. It's changing in terms of the channels where you can sell. But the intrinsic art and craft of creating brands consumers love, that is always at the heart of what we will do as a company.
Where do you see India as right now? Is it at the cusp of consumption boom from here on, largely because a lot of things that the government has done over the last 12 months or so, the street believes that maybe going forward they will bear some fruit. How do you foresee the very near future, medium term?
Yeah, let me talk medium term, and I think it's very important in the context of India to talk medium to long term. Yep. I think, whether it is the GDP growth of the country, whether it's the demographic dividend of the country, remember that India now has, almost 400 million young Gen Z consumers. They're changing the way India consumes, what India consumes, how they consume. So there are different segmentation variables, whether it's the per capita income shift that's taking place in the country. All of these, when they come together, or it's the way you can discover brands today, both because of the digital acceleration in the country or the channels where you can buy, India is more ready than ever before. And I think that's the exciting moment that we find ourselves in. We are living longer. We want to live better. So no matter how you look at it, India is transforming. And, we have to be positive that we can indeed make the most of this change and this moment that India, and finally India has that moment to really see the demographic dividend and the overall consumption change.
And internally, how would you say HUL is transforming to benefit from the transformation of India?
So, Mangalam, I've been very public about the 4 things that I'm talking about. The first is that, we see an opportunity to have a more segmented approach to India. HUL is a company which is not a single brand company. Within a category, we're a multi-brand company. And the power of HUL lies in the incredible reach from the top of the pyramid to the bottom of the pyramid with our brands that we have. So, you can reach consumers not just at the top of the pyramid, but also at the bottom of the pyramid because of the range of brands we have. But we're segmenting much more our go-to-market models for each of the ends of the pyramid of the country. We're bringing in much more capability, whether it is in the way we do marketing or in terms of distribution and sales, to segment much more the population and the geographic dividend that the country will have. So that's the first part of what it is. The second is, and I sort of reference this, which is we are making our brands much more contemporary and modern. It's absolutely clear, right? All the young people in the audience today, in the way they see, process, and actually look at brands is very different today. And it's a very exciting place to be. How they consume, what they're looking for, and really opportunities to make our brands more modern, more contemporary, and we're working towards that. And of course, continuing all the good work in terms of our cost base, the scale that we enjoy, that is work we will continue.
When you said that a customer chooses every day from her wallet, could this also be because the brand is present at places where the customer goes, and the distribution, physical distribution, how big a moat is that, and how long does that stay at a time when quick commerce is something which is fairly prevalent as well?
No, I think absolutely. Listen, firstly, it's a very exciting omni-channel market in India. But the one thing I want to say is every channel in India grows. And that's the incredible thing about being in India and being a part of the Indian economy, is whether you're in, depending on the consumer and the income strata to which you're talking, you need to have strength in every different channel environment. So absolutely, quick commerce is a very exciting, and developing channel in the country, and it forms a big part of the delta growth today. But that does not mean that general trade does not grow. So every part of the different omni-channel environment of India is growing.
And what, according to you, is the next billion-dollar category?
So, listen, firstly, HUL operates as a diversified conglomerate, as you know well, Mangalam, in the country. I would say to you, we've made our point of view clear, right? That, listen, we see the overall space of beauty, personal care, and wellness as the big driver of delta growth for us as a business. And that's the area we will double down.
Okay, all right. Well, let's welcome Bino, the head of research at Elara Securities, who joins us on the show. Hi, Bino. Good morning. Good to see you. When, geopolitical tensions continue, hopefully we hear about some de-escalation. Since you heard the chat that Mangalam had with the HUL management, what's your view on the stock? One of the biggest underperformers in the last 5 years. But we have seen this in the past, and once it gets going, it could very well, catch up in no time. However, this time the triggers are missing. Your take on the stock?
So for last few years, people have been waiting to see some spurt of growth coming from the HUL company and their portfolio. We have seen a significant consumer spend pickup in select categories, especially more on the discretionary side, in select retail, in airlines, hotels, even on automobiles, etc. But the traditional FMCG, which people refer to when they talk about consumption, is yet to show a significant jump in growth. Part of this could be, like the CEO explained, the wallet share has moved away from traditional FMCG to new age brands, new ways of spending, new life experiences, etc. So HUL rightly is now trying to refocus their energy, their brands, etc., to address a new category of the population. And hopefully that revives some growth for the company. We have seen the multiples come down over the last few years. I do not see significant multiple derating from these levels, but upside would depend upon how they execute their new strategy and get those new brands and new vibrants into their products.
Bino, hi, morning, and thanks for joining in. I was just seeing the Elara note on IT released yesterday, where you'll argue that after a 20% correction seen in the stock prices of IT companies in the last 1 year, the valuations are now compelling and you are constructive on the sector. So what are you recommending to buy, and what could be the extent of gains? Is this going to be a tactical bounce because growth is going to be limited? Maybe we see a valuation pickup because the pendulum has swung too much on one side, but meaningful returns could be difficult in the absence of good growth?
So any discussion on the IT is right now a discussion on how the artificial intelligence scenario will play out globally. There are differing views on the same among people. Our view is that artificial intelligence does not mean the end of IT industry. We believe that there will be a lot of new services that come up that can be tapped into by the Indian IT companies to create a new wave of growth. But there is an interim period which we are going through right now, where the traditional IT services are not growing. And at the same time, the new AI-related opportunities are yet to take off in a meaningful way. So this interim period of pain, we have already seen it over the last 1 or 2 years. Possibly, we could also see it for another maybe 2 quarters, 6 quarters, maybe even 12 quarters. Very difficult to put a pinpoint number there. But at the same time, there is definitely an era of growth that is coming beyond that. How to time this is the key question that comes to mind when one thinks of investing in Indian IT as of today. But now, given the huge correction in stock prices over the last 2-3 months in the wake of this AI-related disruption, we believe that a lot of this, if not completely, a lot of this is already priced into the stocks. And hence, at least from a near-term perspective, we expect a rebound. If the rebound is sharp, then possibly some of that may again get priced in. But beyond this interim period of disruption, we do look forward to an AI-led leg of growth of the Indian IT companies.
And in that context, have you all analyzed fractal analytics? Does Elara have coverage? And if yes, what have you made of the Q3 numbers?
Sorry, we do not have a coverage on that.
All right.
All right, so that's the word. What do you make of the oil and gas space right now? There is a fair amount of disruption, but now there has been a 30-day reprieve that has come in. Do you think that's enough to settle matters for now, and maybe the decline in these stocks stops?
So from the direct impact of higher oil prices perspective, the new deal that has been reached, not exactly a deal, but the reprieve that US has given to import oil from Russia does help. So that will contain the country's oil costs for the time being, which should help some of these stocks recover. The directly hit stocks like oil marketing companies, airlines, etc. Some of them should recover with this move coming in. But having said, it is still an evolving scenario. We need to see how the war pans out, how long it goes, whether the Strait of Hormuz remain closed materially for a significant duration, etc. All these will impact the price of oil. And if the price of oil stays high, even the oil imported from Russia is unlikely to be materially cheaper. So all this put together, the risk is still hanging over the head. It is still not completely mitigated, but definitely this waiver is a good step for the time being. But you also need to understand that the impact of high oil prices goes much beyond the oil and gas sector. Freight costs have gone up. Other commodity prices typically tend to go up in line with oil. All these can impact other sectors as well. So if this war continues for some time and lingers on, then we could see a commodity price-led margin compression across many sectors, not just oil and gas. So we need to wait and watch for events to play out in the Middle East.
Bino, stay on. We need to slip into a very short break. On the other side, we'll also get in our technical experts, Shrikant Chauhan of Kotak Securities and Mitesh Thakkar of Bonanza Portfolio, for a few technical trading ideas.
Welcome back. You're watching us here on Bazaar Morning Call. The GIFT Nifty is still indicating a sharp downtick at the open, bringing back, the earlier lows of around 24,303 back into the picture. So that's something that we will monitor. What happens at the gap down? Do we see some sort of recovery coming in or not? And if there is positive news for Reliance, does that stock take the index higher or not? But Bino Patiparampil still with us. Bino, in the pharmaceutical space, the big talking point right now is the semaglutide opportunity. Do you think there is a play in India because of that, or maybe everything is discovered and the opportunity has been sized up and in the price right now?
Semaglutide opportunity opens up in various markets globally starting this month. India is one of them, probably some other big markets like Turkey, Brazil, etc., and possibly Canada as well. Indian companies have a play in almost all of these markets, and it's going to be a very big opportunity. Taking India specifically, our internal estimate is that this could be $1 billion market over the next 4 years. That is a significantly large opportunity, which we have not seen in a single subspecialty in the Indian market earlier. To that extent, it can possibly take up the growth rates of the Indian pharmaceutical market as well. All of this, I don't think, are completely priced into the stocks. Some of the stocks which are front runners to gain from the semaglutide opportunity leaves still some upside on the table in our view.
All right, we take that point. Bino, thanks a lot for that. In fact, just as we speak, as a note for our viewers, on Monday at 3 p.m., we have the semaglutide town hall, sizing up the weight loss drug markets, the impact that it could have not only on the pharmaceutical space, but could there be a second order impact or not? The Ozempic trade, could that impact your portfolio or not? And that's the kind of lineup that we have of people who will be speaking on that show. So Monday, 3 p.m. onwards is where you can catch that. Thank you so much, Bino, for joining in and giving us your views on a whole host of stocks and sectors.
Okay, all right. Before we move any further, clarification on some news that was reported yesterday. Sky News Arabia's X account at 2:23 p.m. IST on March 5th put out a post saying that Iran was ready to abandon its nuclear program on the condition that the United States presents a satisfactory alternate, quoting the Iranian Deputy Foreign Minister. This led to a global market reaction visible in the US futures and crude prices. CNBC-TV18 then put out the news with an attribution to Iran's Deputy Foreign Minister. But in the subsequent 10 minutes, a clarification was put out by Bloomberg, quoting Iran's state-run IRNA, saying the comment by Iran's Deputy Foreign Minister is related to earlier talks with the United States. The clarification was duly clarified by CNBC-TV18. Okay, all right. Remember, we are at CNBC-TV18 are there for you in the interest of our viewers. So please always keep that in mind. For the time being, we'll slip into a short break. On the other side, we'll get you the pre-open rates. We'll also get Prashant Biyani of Elara Securities, who will be joining in to focus on the fertilizer space. Well, in a few minutes from now, we'll be getting the pre-open rates. But for the time being, let's focus on some of the tech names. It has been a very, very weak February for the IT names. Hormaz joins us with some details and some data crunching that he has done. Good morning, Hormaz.
Good morning, Nigel. And it was a forgettable February indeed for all of these IT names. The IT index itself was down almost 20%, worst month for it since September of 2008. And it's the kind, and almost every IT stock fell in double digits in the month gone by. You look at names like Coforge, that was down almost 30% in the month of February. Then look at LTI, Mindtree, Tech Mahindra, Persistent, Infosys, all of them down in excess of 20% in just 1 month. And the other constituents as well, with TCS, Emphasis, all of the others were also down anywhere between 10 to 20%. Every single constituent of the Nifty IT index was down in double digits last month. The story here is that during this period, there was a significant increase in the leverage positions for these IT names, according to the NSE MTF data, if you can check that, because if you take a look at these positions as well, starting the 1st of February, compare that to the 4th of March, for which the data is currently available from. Look at TCS at the 1st of February, the leveraged positions here stood at just over 850 crore. That number has gone up to as much as 1200 crore as of the 4th of March. Same is the case for Infosys as well. A 232 crore MTF position has gone up to as much as 900 crore as of the 4th of March. Wipro's positions have doubled as well. Persistent's positions have nearly tripled. HCL Tech's positions have nearly doubled to almost 200 crore rupees as well. And interestingly, this comes at a time when the FIIs were significant sellers of IT stocks in the month of February. They dumped IT stocks worth close to 17,000 crore rupees last month, and as a result of which the combined net investment of the FIIs in this sector is at a 4-year low, and the total value of that also fell almost 22% last month to just over 4 lakh crore rupees from nearly 5.5 lakh crore at the end of January. So IT stocks were down, yes, in the month of February. What was not down though were the leveraged positions. They have seen a significant increase. In fact, TCS is now the 3rd or the 4th most leveraged stock in the MTF book as of the 4th of March.
All right, we take that point. Thanks a lot for that, Hormaz. That's some data, that's some telling data. Mitesh Thakkar of Bonanza Portfolio now joins us this morning. Alongside him is Srikanth as well. So good time to get in some of the trades for today. Mitesh, yesterday there was a fair amount of volatility. Yes, there was a bit of a relief. But now it seems like this morning there would be a decline at the open itself. Do you think this is a dip that could be bought? Or maybe you'd want the market to settle before taking a call?
Good morning, Ma'am. I think I've been maintaining that we could give a bounce back because if you look at the last 4 days of data from 25,600 the last Thursday, we kind of went to about 24,300. And therefore a pullback was possible. I think yesterday's bounce, and I actually mentioned that till we start getting past 25,000 again, I think all the up moves will be classified as bounce back, and only closing about that 100 zone would suggest that the decline is over. So we are still far away from that. The medium term charts are still negative. But given the fact that we haven't really come out of the oversold situation, it could be a choppy, narrow range for the next few days. But I think eventually there's a chance of us heading lower. So for the timing one, I think today, if we open gap down, I would want to see us get closer to 24,400, which is where a support pivot is, and that's where your buying zone comes in. Two, I think I'll keep a very close watch on the bank nifty. Yesterday also I highlighted this bank nifty around 58,400, 58,350 is a very important medium-term weekly support zone. So I think we got a low of 58,393 on Wednesday. So I think around those levels, if the bank nifty comes, if the nifty is close to about 25,400 and we are seeing 24,400, and if we are seeing some kind of a slowdown in selling, then I think it'll be time to go.
All right, and before we go across to Srikanth, we'll ask you your individual stock picks, and alongside that also tell us about Reliance, because the stock did well in yesterday's trading session. Do you think it has enough to go further higher from here?
Reliance, again, if you look at the daily charts, among them around 1350, we have had two closing lows. It's trying to reverse, but as of now, I'm not sure that the reversal has come into effect. So I think for the timing, 1350 should be a support area, and traders should look to buy around those zones. On the upside, 14, 20, 25 will be a very difficult level for the stock to get past in the short term. So that's the area where people could exit and take profits on long positions.
All right. Let's welcome Srikanth as well. Srikanth, your index calls for the day?
Good morning, Mangalam. Good morning, everyone. So for Nifty, it is we can say holding above the level of 24,300, 24,500. In fact, yesterday, we saw a good amount of buying traction close to 24,500 levels. But in case if we see the market is breaking that level, then again, we can revisit to the levels of 24,300 and maybe more. So for the day, specifically, 24,500 is going to act as trend deciding level for the market. On the higher side, 24,800, 24,850 going to act as major resistance. And on the dismissal of that only, we can expect some short covering. Otherwise, we are expecting market to remain in a range. And at higher levels, we are expecting some more liquidation of long positions.
Okay, got it. Hi, Srikanth. Morning. Good to see you in. Individual stock calls?
Good morning, Nigel. For the day specifically, we are of the view that we should look for adding some metal stocks. In that, specifically, we like Vedanta, which was around 711, 712 yesterday. From here, again, the stock can move towards the levels of 730, 745. That's the view. We should look for adding this stock at current levels with a stop loss close to 700 or below. The other stock on which we are bullish is Bharat Electronics. There I am expecting rising top, rising bottom series. So the possibility of hitting 470, 475 is much higher. And on the weaker side, Hindustan Lever looks weak. There we are expecting further more weakness. The stock can fall to the levels of maybe 2150 or 2100. So there we should look for taking some short bets in the near term.
Mitesh, hi, good morning. What stocks are you going with?
Hi, I think, the stocks which I have on my list are more on the sell side. Couple of banking names feature after a long time. So Axis Bank is a sell with a stop at 1362 for targets of 1325. Bank of India as well, from the banking side, is on the negative side. I think, the stock can be sold with a stop at 166.5 for a target of around 157, which will be a slight kind of a pullback move. Buy on Coal India. Yesterday, the price action volume was good. So if you get it slightly lower in the morning weakness, buy with a stop at about 437.5, 437.80. And look for a target of 465, while Dabur is a sell with a stop at 496.5 for targets of around 470.
Right, that was a sell, and for Shrikant, HUL was a weak stock as well. So obviously, the FMCG pack doesn't have many takers this morning. But Shrikant, I'll ask you for your view on Reliance once again, because it did well yesterday. Again, does it have enough legs to move further today? Because from a market standpoint, that's important. The Nifty Bank obviously has some supply around that 59,200 mark. That's what we saw yesterday as well. And technically, it's the 100-day moving average out there. The IT index not very well bid. So if the index has to find some support, it has to look at Reliance. Chartically, are there any levels that we should be monitoring?
Yeah, absolutely. I think if in this market, if we can see any particular recovery in the market, then for that, we are expecting recovery to come from Reliance Industries. Even if we go through with the daily charts, then multiple times that stock has taken support between 1350, 1360. And in last 2 days, if we see the relative performance of Reliance versus other stocks in the Nifty 50 basket, then the Reliance did really better than other stocks. While looking at its technical pattern, it is diverging positively. Based on that, I am expecting stock to move towards the levels of maybe 1430, 1440 in the best case scenario. And in case if there is any weakness, then I think this particular 1350, 1370 going to act as major support. Ideally, we should look for taking some more long position if there is any weakness in the market, especially in Reliance.
Okay, thank you very much for joining in. Let's talk about the fertilizer space. Now, on account of the supply shortage because of Qatar shutting down the LNG facilities, we've seen a spike in LNG prices and a supply cut. Now, this is negative for Indian fertilizer companies because LNG, or the natural gas, is converted into ammonia and then into urea. So LNG acts as a primary feedstock into the production of fertilizer companies like Chambal, RCL, RCF, GNFC. So we have with us Prashant Biani joining in to talk more about the potential supply disruption for the fertilizer names. He joins in from Elara Securities. Prashant, thank you very much for joining in. Just for the beginners, if you could explain how are fertilizer stocks exactly impacted and to what extent?
Fertilizer availability in India in Kharif should not be a challenge as of now. We have adequate closing stock of both urea as well as phosphatic fertilizer. So if you see, as of 15th of February, in urea, we had closing stock of around 4.1 million ton, which is equivalent to 2.5 months of consumption. And at annual production of around 30 million ton, the monthly run rate comes to around 2.5 million ton. So if you take into account some disruption and some curtailment of gas supply, even then we are quite better off in terms of availability for the Kharif season. In case the domestic manufacturing, is not suffice enough to fulfill the demand. In Oman, we have JV by IFCO with the government of Oman. So we have adequate supply of urea as well as phosphatic fertilizer. So I don't think there is any cause of worry, even if there is some curtailment of gas supply. We would be well enough in terms of availability for both urea and phosphatic fertilizer.
From a lead time standpoint, Prashant, how are we? Because we're currently in March, and it's usually the first quarter, which is seasonally some of the strongest for fertilizer sales, right? So do you see any of this impacting the most strong quarter for these companies because of supply disruptions, or do you think it'll sail smoothly?
It should sail smoothly, and rather, in terms of in times of these disruptions, fertilizer sales are generally, bought beforehand by farmers. So because of pre-buying, I don't see any disruption in volume. And as I told, that availability is not a concern at all as of now because of closing stock and because of decent self-dependency in urea. I don't see a challenge in terms of fertilizer availability. We should be able to sail through. There may be pockets of disruption here and there, but that would be at best because of logistical issues, not because of availability per se.
If you could elaborate on the potential pockets of disruption.
So every year we hear that, at some places some fertilizers in shortage temporarily. So that may be because of realignment of rakes. by railways. So I think it would be restricted to that.
And what's your call on individual stocks in the sector? If you could enlist your top picks and the target prices?
See, right now, the near-term movement is hinged upon how the situation pans out in the Middle East. But otherwise, we are structurally positive on Coromandel as well as Paradeep Phosphate. Both of them are in phosphatic fertilizer space. And I think both of them act as a very good proxy for import replacement, given both of them are doing capacity expansions over the next 2 to 4 years. So these two are my picks as far as the fertilizer stocks are concerned.
Okay. So no risk of EPS downgrades, according to you?
The EPS downgrade is also a function of the backward integration spread that these companies enjoy, both Coromandel and Paradeep. So for that, we have to continuously track the movement of raw material prices as well as the level at which government sets its subsidy. So I think in a month's time, when the government announces the subsidy for the next season, and once the raw material prices also stabilize, we would be able to ascertain about the profitability. As far as volume is concerned, we don't see a risk. On the EBITDA or PAT front, I think it is more hinged on the subsidy levels at which the government sets it at, and also the raw material prices.
And what are the scenarios that you're building in for the same? And if you could give us the probability for what one should expect, because if this is more important, then maybe when that happens, say sometime next month, that would be an important imponderable for the sector.
Given that raw material prices are higher and government also would want maximum domestic production, so I think the nutrient-based subsidy should be set higher. In terms of backward integration related profits, I think sulfur prices have been a pain point for the industry. So at best on the backward integration spread for phosphoric acid, I think that could remain flat on a YOY basis. So overall, I think H1 profit may look marginally higher or flat at best for the phosphatic fertilizer companies.
All right, take that call. Thank you so much for joining in and giving us your view on the sector, top picks, and the impact which you believe because of this disruption in the very near term on volumes would be fairly minimal or negligible as well. Profitability and EBITDA, obviously, policies over the next 1 month would be a crucial level to track. With that, we speak about some other brokerage calls that have come on today, come so far today as well. So Darshan has gone through all of them. So what are you picking out today?
So we start with CLS's note on infra companies, both IRB and NCC, and recently both these companies had seen buying in the via open market by the co-founders or say founders. And so CLSA maintains the outperform call on IRB with a target price of 69 rupees per share, on NCC outperform call with a target price of rupees 234 per share, and says that insider buying is generally considered a sign of likely turnaround. And founders recently bought small stakes but sends a big message of confidence in the business. For IRB, tolling business has surprised with 11% YTD growth at India's #1 toll platform. Also, company had announced FY30 plan to become net debt and growing asset by almost 75% over next 3 years. As far as NCC is concerned, Q3 was weak, but company is expecting a pickup, and that might start in the current quarter or say Q4 FY26. That's the reason CLSA is positive on both these names. Second one is Citi has initiated coverage on Orkla India with a buy call, and target here is 750 rupees per share. It says company is a key F&B player operating across pure and blended spices and convenience packaged food. It's #1 player in Karnataka and Kerala, and also has significant presence in other southern states like Andhra Pradesh and Telangana. Some of the constructive view is underpinned by first, strong category tailwinds, second, market leadership in South India, and third, effective execution of portfolio expansion and channel diversification. UBS has initiated coverage on Pine Labs with a buy call, and target here is 250 rupees per share. It's a leading B2B payment platform across large enterprises, and enterprise-led annuity base with scalable monetization that might be positive for the company, and also affordability underpins incremental growth and margin expansion. As far as the valuation is concerned, company trades at a 45% discount to Paytm on FY28 estimated EV to EBIT, and that UBS believes that it's unjustified, seeing the growth that company has seen over the last few years, and also it's the outlook that the company has given over the next few years.
Thank you very much for that. Both Pine Labs and Orkla were recent listings and both are trading below the issue price. For Pine Labs, the issue price was, I think, 221. The stock is at 176. For Orkla India, the owner of the brand MTR and Eastern Condiments, the issue price was 730 and the stock is down to 586. So this morning, there is a positive note. Mitesh is now back with us. Mitesh, do you have a view on Pine Labs or Orkla India? I know limited trading history.
No, I am not really working them.
All right. We'll come back to you for more on your 9-10 calls. But as the war in West Asia widens, data accessed by CNBC-TV18 shows that 2,325 flights have been cancelled between February 28th and 5th of March due to the West Asia airspace disruption. Madiha joins in with the details.
Well, the West Asia conflict continues to cause major turbulence for aviation, and exclusive data accessed by CNBC-TV18 shows the scale of disruption is only growing. So since the 28th of February and the 5th of March, a total of 2,325 flights have been cancelled due to these airspace restrictions across the Middle East. And out of these, 1,770 flights were cancelled by Indian Airlines, while 555 flights were cancelled by foreign carriers. The passenger impact is also massive. Nearly 3 lakh travellers have been affected so far due to these cancellations, and around 16,000 passengers are still stranded across different Gulf airports. What data also says that airlines have been trying to bring back passengers, and on 4th of March alone, 28 inbound flights operated from Middle East airports brought back over 5,300 passengers to India. Now, if we look at the day-wise cancellations by Indian Airlines, the numbers clearly show how severe the disruption has been. On 20th February, about 196 flights were cancelled, and that jumped to 348 cancellations on the 1st of March, 357 flights on the 2nd of March, which was the peak of the disruption. And after that, 319 flights were cancelled on the 3rd of March, 269 flights on the 4th of March, and on March 5th, airlines cancelled 281 flights. Now, if we break this down airline-wise, Indigo accounts for the highest cancellations at 806 flights in these 6 days. That followed by Air India Express with 580 cancellations, Air India with 229, SpiceJet with 123, and Akasa Air with 67 flights cancelled since the start of the disruption. And the reason this disruption is continuing is because several critical airspaces in West Asia still are either closed or operating with heavy restrictions. So Tehran, Baghdad and Damascus remain shut till the 7th of March. Tel Aviv's airspace is closed till the 9th of March, and Kuwait and Doha are operating rolling closures depending on the security situation. The UAE is partially open. Jeddah in Saudi Arabia is accepting flight diversions, and Muscat is open but with operational restrictions. So for now, airlines are still rerouting flights using these alternative routes, cancelling services and reviewing alternate air corridors, which means the disruption to travel between India and the Gulf and even Europe could continue in the coming days.
Right, Madhya, thanks a lot for that. So the disruption continues. A heart only goes out to, all those stranded passengers who would be rushing to go home or, go to the plans that they had earlier made. We'll obviously, in moments from now, probably get Mitesh and Shrikant back for the 9-10 calls. But as we do that and as we await market opening, here's a quick recap of all the top stocks that we covered earlier this morning. We obviously have Reliance Industries, IOC, BPCL, HPCL, ONGC, Oil India, because of the 30-day waiver that has come in from the US to import Russian oil. So there could be some supply pressures easing, and that could be a positive for them. Fractal Analytics on their first set of results post-listing. Stocks up around 2.5%, a little closer to 3% in pre-open. Dr. Reddy's is the other stock that we're tracking. Sami Hotels made an acquisition. That's a stock that we're tracking along with Tata Elxsi as well. But for now, less than a minute to go for opening, about 25 seconds, Rima. The pre-open has settled about 109 points lower. Not as bad as what the GIFT Nifty would indicate.
Indeed, the GIFT Nifty was suggesting a cut of about 200, 250 points, but Asia itself is also largely positive. Yuan seeing a big sell-off, a broad-based sell-off across the Asian market situation. Yesterday, we had a relief rally after 3 days of selling. Yesterday, the Nifty bounced back nearly 300 points. The bell has gone and there is a gap down opening to begin trade with. The Nifty opens at 24,620. That's a cut of about 140 140, 150 points at open. It's down 0.6.7% for the benchmark indices. So the Nifty has a gap down opening, and it now takes the weekly loss on the Nifty to in excess of about 2%. Mid-cap, small caps also selling off relatively, though, a little not as bad. The mid-cap index is down close to about 0.25%, and the advanced decline ratio is about 3:4. 3 stocks advancing for 4 stocks declining. Sectorally, if you just have to get a color on what's dragging today, well, private sector banks continue to be weak. Autos on the back foot. The Nifty Bank is taking the biggest hit. The Nifty Banking Index is down about 0.75 of a percentage point. Realty weak. And on the way up, you have IT holding up on one end. The Nifty IT Index is in the green. The Nifty IT Index, remember, had a 20% fall in the month of February. And even this week, while the Dow is down more than 2% globally, the Nasdaq cut is limited to about 0.5%. So it looks like maybe for now, the worst on the tech sell-off could be overdone. So HCL, Infosys, Wipro, all on the gainers list with a gain of 1.5%. TCS, Tech Mahindra also in the green. BEL continues to shine. BEL, that's the defense name, top Nifty gainer, now 1.25% up. For the week, it's up nearly 5%. On the way down, Interglobe Aviation continues to get hit hard. Now the weekly loss stands at 9% for Interglobe Aviation. We spoke about banking drags coming through from ICICI Bank and HDFC Bank. And other losers include Max Healthcare, Asian Paints. Again, the rise in crude prices, 18% increase in Brent crude price so far this week. And Asian Paints has taken a knock. And L&T had a bit of a respite yesterday, 4% gain. But today it's sold off. So there is weakness on L&T.
Okay, all right. Well, from the broader markets, there are a few stocks actually that are doing pretty well. DCX Systems, one of those rank underperformers. I don't think from the IPO price the stock has moved much. They've raised equity at higher prices as well. For the timing, they've got a 70 crore order from HAL, so the street likes it. On NMDC, well, they've gone ahead and they have increased prices. On Lumpur, the effective price increase is around 100 rupees. And on fines, it's around 50 rupees. So a small increase, but this is the second straight increase after February. February, remember, was relatively lower. But an increase is something that the street will definitely like. What else is moving in today's trading session? Karnataka Bank, actually, that one's bouncing back and the volumes are fairly good as well. So just keep an eye out on that particular name. From the broader markets, another stock that's doing well is LT Foods. The stock is up close to around 7%, so massive move out there. Ramki Infra, for this week itself, the stock is up close to around 10%. Today, it's put on close to around 5%. And Marscon Dock, yesterday the stock was up. Today, it's seeing some follow-through, so no profit-taking being seen on that name. I think the tech index, actually, after having a weakish session yesterday, that's bouncing back today. So Infosys is up. That's what's leading the charge for the tech stocks. So that one as well is doing quite well. The tech index at 29,800 mark is extremely important. Multiple times we've defended that mark. So the bulls will want to believe that actually there is some life left in some of these names. Let's see whether or not that does break. Other stocks in focus, Aban Offshore, stock locked up close to around 5%. But otherwise, the headline index is down 150 points on expected lines as per what the GIFT Nifty was suggesting. The Nifty Bank, that's the problem pocket. That's down a good 500 points and it's 1,000 points away from its 200 EMA.
Take that point, Nigel. You know, the Nifty Bank is under pressure, and that's what's keeping the Nifty under pressure, and an otherwise decent performance coming in from the other two heavyweights. So the Nifty IT index is up around 1%. We have Reliance as well, which is opened fairly higher, about 0.2% in terms of gains. And the broader market actually is a lot better than what, the frontline indices would reflect. In fact, the mid-cap index is now virtually about to break into the green. It's curtailed its cuts from the open, and as compared to the frontline index, the mid-cap index is falling a lot lesser as well. We have almost an equal number of stocks which are advancing versus the number of stocks which are declining, which is a lot better than what the frontline index would have you believe. And while the frontline IT stocks are doing well, look at something like a Persistent Systems, KPIT Tech, and Coforge. All of them up anywhere between 1 to 2%, and Angel One is the other one which is picking pace as well. A couple of these travel-related names. Yatra Online has been on a tear over the last few trading sessions after a big cut that we saw in the earlier weeks. So that stock continues to do well, up around 2% this morning. And we've seen some traction on Sami Hotels as well, a near 60 crore asset-light acquisition that the company's made. The street likes that. And Orkla India, the owner of MTR Foods, has seen a big cut from its post-listing highs. So about 25% off its highs this morning, finding some buyers. Also down, the volume curve, we have Spencer's Retail, which has moved higher, Suntech Realty, KRBL, which is moving, and you have, Zaggle Prepaid, Schneider Electric, a bunch of them, all of them higher, up and about in today's trading session.
Well, Reliance Industries is providing support for the second day in a row. The 30-day waiver given by the U.S. government to India to buy Russian oil cargo stuck at sea is helping. Reliance Industries has now crossed the 1400 mark yesterday. The stock was up to 3% and it's seeing upward momentum today as well, aided by this potential news. It's a stopgap arrangement, but it does help the oil refining companies, Reliance Industries, and even the other oil marketing companies, though you aren't seeing a positive reaction in IOC, BPCL and HPCL, because the rise in crude prices is also simultaneously affecting the marketing margins of these companies. So that's the reason why those companies, IOC, HPCL, BPCL, are flat, but Reliance Industries continues to see buying, and that is providing some support. So some breather coming through, at least on the oil and gas picture. Gautam Trivedi, co-founder Nepean Capital, is now joining in. Gautam, you want to share your thoughts about this entire conflict, the Middle East tensions, because India has a fairly high exposure on Middle East in terms of remittances, crude, all that is documented. But given the way sentiment was and now this news, what have you made of where we are right now and where we're headed?
You know, it's unfortunate that what's happened in the Middle East, in terms of timing, because if you look at the fact that for the first time in maybe about 18 months, we had a net positive FII flow into India, over $2.4 billion for the month of February. That was the third highest among emerging markets in that specific month. We had a host of positive news flow as well. We had the India-EU deal. We had the US trade deal announcement, which obviously included the immediate lifting of the additional 25% tariff. We had better than expected third quarter results. So, things were going in the right direction until this happened. And of course, now that, we've seen money leaving the US, a lot of, funds are now global emerging market funds, as we call them, GEM funds, are seeing pretty significant inflows. In fact, the figure that I have as of last Friday is as much as $54 billion of money coming into emerging markets. But unfortunately, I guess India is not necessarily going to be a beneficiary of that, given what's happening in the Middle East and our dependence on imported oil.
All right. Hi, Gautam. Good to see you in. Looking great this morning. Well, hopefully the markets as well pick up for the remainder of this year. Gautam, you're a stock picker, and these kind of opportunities actually provide a good entry opportunity. You buy the stock of your choice at the valuation of your stock, your price, and obviously that would mean at the price of your choice as well. Give us a couple of names that, y'all have gradually been building a position into, or you'll have built onto a position you'll already had. Because, the first part of March is normally weak. That's a seasonality that plays out. Now you have the geopolitical issue. So stocks are seeing a sharper drop down in the last few days. If you could name a few.
Yeah, I have to be careful about naming stocks, but I would talk about sectors specifically. Again, people who actually want to look at stocks, you can run screens. The top 1,000 companies have seen about 670, 680 companies that have fallen 20% or more from their respective 52-week highs. So obviously, there's a lot of good companies in there that are potentially ripe for picking. However, having said all of that, I still don't think now is necessarily the right time to start buying, only because we just don't know how long this was going to go on for. Again, I think we need to always, before looking at getting and dipping back into the market, look at the absolute flows that are coming into India as well as on the domestic side. So if I were to just go back for a minute to the figure I mentioned, $54 billion of money coming in to global emerging market funds, and I'm reading some of these numbers off my screen here, and you've seen dollar returns this year alone. I'm talking of in the last 2 months and 5 days. Korea's up 54%, Taiwan's up 25%, Brazil's up 21%, Turkey's up 24%, South Africa, Mexico 18 to 17%. We're down on these are all dollar denominated returns for the year. We're down 4%. So I think the market does understand that the impact of the Middle East crisis is pretty significant. And don't forget, the price of oil, i.e. Brent, is up 35% year to date. And it's not just the move in the last 1 week since the war broke out. It's, we were at $60 at the start of the year, and we're now at 84.5. So I think a lot of this is getting priced in And the market, of course, has to be cautious. Investors need to be cautious about deploying more money at this point. But answering your question, I think there are opportunities emerging within the EMS space. I looked at some of the hotel names, one particular hotel that we've been tracking for a while, which we missed, but we like. It's come off significantly. And then I think a way to play the GCC space, again, I think some of these co-working companies have got beaten down 20 to 25% since their listing or since the last 12 months. We like that space. And anything to do with data centers. And I mean, not just, there aren't too many pure data center plays, but the overall data center ecosystem throws up a lot of opportunities. And again, power being central to data centers. So we like those themes.
All right, we take that point. I would be curious to know more about the hotel stock that you've been tracking for a very long time, and now that's come off. But be that as it may, you seem to have brought about a sense of cheer, at least in the broader market right now, because as we speak, the advanced decline comes up for you. The Nifty mid-cap index has made a stellar recovery from the lows. It's now higher by about 0.5%, and we have nearly 2 stocks advancing for every stock which is declining. And this number has moved swiftly in favor of advances in the last 15 minutes or so itself. And, while it's more of the same, Mazagon Dock up 4%, the IT, mid-cap IT stocks doing well, Solar Industries, Bharat Dynamics doing well. We have a couple of these financials which have come back in, the up move as well. So IREDA is one that comes up for you. We're seeing some traction in JSW Energy. And in the frontline end of things, Shriram Finance is one which has recovered sharply from the lows. Gautam, while you did say that there are a lot of stocks which have corrected and they are providing entry opportunities, though you are, cautious of deploying a lot of capital right now, the other school of thought is that during times of crisis, companies and stocks that display resilience are actually the ones that stay even more resilient when there is no crisis as well. So in the defense space, in, any of those beneficiaries from the war and the prices of that, say maybe the aluminum space, etc. as well, do you think there are plays here which can be carried on beyond this initial disruption?
The answer is yes. I think on the defense side, we've stayed away only because valuations have been really excessive. But on the metals front, we don't invest in commodities as a rule. But having said that, I think for the wider audience, metals would be interesting, whether it's copper, whether it's aluminum, maybe even gold and silver at these levels. So the answer is yes, there are other opportunities within the market that, besides the ones that I've listed. And what would they be? Gautam?
Some ancillaries?
No, you mean within defense or, sorry?
Within the metals. I'm interested with metals. You can tell Mangalam about the defense since you briefly mentioned about metals. Metals, will you go on for the ferrous and non-ferrous names, or would you want to go for the graphite electrode makers, the CPC makers, or play it with a bit of a twist out there?
I think the fact that we now have such huge inflows within the gold and silver, specifically gold ETFs. You saw the number of last month, 24,000 crores, almost matching the number that came into the equity mutual fund in terms of absolute net flow. So I think there are products available to play gold in India, besides, of course, trying to play it on the MCX in terms of futures. But my view is that I would stick to the ferrous and non-ferrous. That's the limited understanding that I do have of commodities. Outside of that, ancillary units, I'm not very comfortable or don't know enough about.
From your friends in the mutual fund industry, are you getting a sense about disenchantment towards equities because we've not gotten returns? We keep hearing headlines which appear to be negative. Generally, has there been a moderation in the pace of equity inflows? I'm not talking about redemptions, but the pace of inflows slowing down. And is that a headwind that you foresee for 2026?
Rima, I'm glad you brought that up because the market has been propped up over the past about 18 to 24 months on domestic fund flow. And last year was a record $88 billion. This year to date, we've seen a record $14 billion. That's, again, mutual funds as well as insurance companies combined. That's a combined number. But I think the fund flow, and I've said this before, may have slowed down a bit. But let's not forget the fact that 5 states account for almost 50% of the total unique investor base of 120 million or 12 crore investors. So the penetration of the equity culture is still left in a very big way. Yes, the returns over the past 18 to 24 months have been disappointing. Are we seeing big redemptions? I think there is a redemption, a number which I don't have with me, but you've seen 31,000 crores of net flows in February. However, the net number, if I do the math, it's about 24 or 25 now. So I assume that the redemption is about 6 or 7,000 crores. So yes, there are redemptions, but new investors coming into the market, first-time investors, that figure, as I understand, is not slowing down.
Gautam, what's the probability that we see a very sharp slam dunk and 2026 goes down as a very weak year? Or do you think India will actually outperform from here on? Because I don't want to name any guests, but there are a couple of guests who have been talking about sharp drawdowns on the headline index, 15-20% as well. Would you completely rule that out? Going by the cues that we have, going by the cues that we have and presuming that we get a resolution on this de-escalation in the next few trading sessions.
I think if it's hugely dependent on what happens in the Middle East. And we're impacted in multiple ways unfortunately, from what's going on in the Middle East. It's not just the price of oil, it's remittances, as Vima mentioned earlier. It's the fact that we are not looked upon. India is not looked upon as a tech/AI, nor are we looked upon as a metals play, which is Brazil and a bunch of other emerging markets that offer a play on commodities. So we are a domestic consumption story, and to some extent, and growing thanks to the efforts of our Prime Minister to become a hardware manufacturing country. But all of that's going to take time to get recognized. So I'm somewhere in the middle. I don't see a doomsday scenario of 15-20% fall. The key thing for foreign investors to come back is the rupee has to stop falling. If the rupee doesn't stop falling, I don't see money coming back into this country. And let's not forget one thing. Let's not blame only the FIs for the situation we're in right now, because if at all they're selling the large caps, but the mid and small caps are being sold by us Indians.
All right. Just a final question before we let you go. Since you said that, we're a domestic consumption story, I'd like to know your thoughts on what are the plays out here? Because the staples not growing, valuations are high. The sectors, the discretionaries which are growing, the valuations are out of whack. So growth has to genuinely, match what the street is expecting. And then the other part of the economy, which India was always the story, which is the services exports or the IT services space, that is impacted by artificial intelligence. So no AI play, no major commodities play as compared to, say, Brazil, if one was looking at a global portfolio. Domestic consumption, you're not left with a lot of options which are, either growing or attractive valuations, and the IT space, which has this sort of disruption coming in.
Here's the thing. I think IT, again, I don't want to, sound too optimistic, but could potentially be the underdog only because it's fallen as much as it has. The last 1 year, 3 years, and 5 years, huge underperformance. Year to date, TCS, Infosys, most of these big IT stocks are down 20%. I mean, literally 2 months, the stocks are down as much as 20%. So question is, how will Indian IT reinvent itself? How will it leverage AI? How is AI going to help these companies, start a new vertical business, possibly? And if AI takes over, if they have to let go people, does that make them more efficient from a cost perspective? A lot of questions are unanswered at this point of time. I think TCS's move to invest $7 billion in a 1 gigawatt data center is a step in the right direction, but for a company with a $100 billion market cap, $7 billion spread over the next 6 to 7 years is a small baby step, but it's a positive baby step. So I think a lot needs to be chewed upon before Indian IT becomes a buy, but at that, to my mind, could potentially be a contrarian story.
Okay, interesting. Thank you very much for staying on. And maybe, Gautam, you want to listen in to the next conversation. We've got the management of Fractal joining in to talk about their Q3 earnings. But before that, let's just get in Morgan Stanley's view. Jonathan Garner has downgraded India to an equal weight stance. So the Indian equity stance now stands at equal weight, given the wide uncertainty around geopolitical developments and the historical negative exposure of our markets to oil supply risks. He also goes on to say, with uncertainty also still swirling around the AI disruption and absolute valuation still expensive, they believe it will take some time and potentially a peak in the tech cycle for Korea and Taiwan before international investors reposition towards India. They have removed Maruti Suzuki from their Asia Pacific ex-Japan GEM, that's Global Emerging Market portfolio, and the Asia Thematic Focus list. So that's the view coming in from Morgan Stanley. India is now an equal weight on account of the rising uncertainty surrounding AI and India's dependence on Middle East. Moving on now to Fractal Analytics. They reported a good set of numbers. Q3 revenues were up 21% on a year-on-year basis. Revenues up 7% quarterly. The company's quarterly profit, the net profit, crossed the 100 crore mark for the first time ever. Srikanth Velamakani, co-founder and CEO, and Ashwath Bhatt, CFO of Fractal Analytics, will join in. And we'll talk about the three main points: AI disruption, the FY27 outlook, and scale-up of Fractal Alpha, and that turning EBITDA positive. Thank you very much for joining in. Srikanth, since the last time we spoke, the disruption to enterprise AI has been mind-blowing, even from the time of the IPO listing. The question is the 21% revenue growth that we've seen in the first 9 months sustainable? Because this is lower than your own 5-year CAGR of about 25-30%.
Yes, this is sustainable, and we expect to continue growing at this number or higher because we see tremendous acceleration with AI progress. For example, every AI system has to match and exceed human performance on that task in a consistent, reliable, and a predictable way. And today, most AI systems are not accurate enough. And as AI progresses, this becomes much more addressable, which means that the number of places where AI can be applied dramatically increases. That expands the total market opportunity for Fractal. And Fractal's moat is that we can understand the ontology of the data inside companies. We know how to understand that data, what's going on in their business, what problems they are solving. This is data that models don't see. So we train models inside the company's own data and build these systems that match and exceed human performance. And therefore, we see a tremendous path to future growth.
I get that you all are specialists with contextual knowledge, and the LLMs, though powerful, are still broadly generalists if we have to simplify it. But the fear is, with the pace of innovation, maybe those generalists tomorrow will be specialists, and then they will eat into your own business. Is that already happening to some extent? And when you say revenue growth sustainable, you're talking about 20%, or do you think you can push higher now to 25-30%, say for FY27?
One metric I'd like to propose to you is that you should imagine what happens if OpenAI releases the new model or Claude comes up with a new model. Are you excited or are you scared? So as far as Fractal is concerned, we're excited because what happens is that underlying these models are in the Cogentic platform, for example, these models are underneath. As these models get better, the ontology on top of that and our ability to reimagine every workflow with AI increases, the accuracy of these systems increases, which means that the relevance and the applicability for clients increases. Therefore, our overall growth actually exceeds. So we are a net beneficiary of AI progress. We are the disruptors, and therefore we can continue growing at this pace or higher for the foreseeable future.
Okay. Ashwath, you want to come in and explain what led to the adjusted EBITDA margin expansion to 17.8%? What were the drivers? And going forward, will the margin expansion continue?
Ashwath?
Yeah, I'll take that. So, our improvement in adjusted EBITDA was mainly driven by improvement in gross margin. Our gross margin went up with more and more engagement type moving to more output-based contract structure. That was one of the improvement areas. And beyond that, our productivity and how we use AI for a lot of our own internal work also led to reduction in the SG&A for ourselves. So these are two big drivers which led to our adjusted EBITDA, which improved. And again, if you look at our adjusted EBITDA trend over the last 3 years, there's been a huge improvement. It's almost more than 10 points of improvement in adjusted EBITDA. And we expect this operating leverage and we doing AI on ourselves and making ourselves more productive and improving the GM by adding more value to the clients. All these three things will add to our adjusted EBITDA and it will keep improving.
All right, we take that point. And a fourth of your revenue that comes in from technology, media, telecom, that saw a 2% decline. What specific headwinds is this space facing, and what's the kind of growth trajectory that you expect for this particular segment?
So in the TMT segment, we had two client-specific issues because of which our revenue declined. Otherwise, in general, for the 9 months, our revenue still increased, but for the 3 months, it declined because in one client situation, the client is not doing well and they're undergoing a restructuring inside their own organization. And this is not a typical Fractal client in the sense that they don't follow the 10, 20, 30 rule for Fractal, which is companies that are 10 billion revenue, 20 billion market cap, or have 30 million customers. So this doesn't follow that rule. And this company obviously went through some restructuring issues. The other one is a place where they have decreased their spends. So if you not account for these two, I think overall the business continues to be good. Across all verticals, across all segments, our business continues to grow really, really well. Healthcare, for example, grew by 78% year over year for this quarter.
Right, but a client reducing business is, while it is client specific, it is also the nature of your business, right? So do you think there is any risk to growth for the TMT segment going forward?
In general, you could say that you should look at our net revenue retention or NRR. Our NRR is at 115% for the 9 months and 114% for the 3 months of this quarter. And it means that existing clients continue to expand business with us every single quarter, every single year. And that's the best way to look at how it works. We also have a churn, which is roughly 1% of revenue. So all of these disruptions, etc., account for about 1% of revenue churn that happens in Fractal. So if you adjust for that, our business continues to grow at the rate at which existing clients expand their business, new clients get added, minus the churn, which translates to the 21% revenue growth right now. And I think which is sustainable and it'll be higher as we go forward.
Srikanth, on Fractal Alpha, which is your sort of the B2B incubation business, still small in terms of the overall contribution to the group, but it's growing well, 51% jump in your revenues. It now stands at 67 crore on a quarterly basis. Your losses have halved from 21 crore, it's down to 10 crore. Are we going to see these quarterly aberrations in the profitability, or do you think this is the sustained path to turning to break even? And when can we turn, break even? Will it be in the first half of FY27 or second half?
Yeah, I'll talk about the trajectory of Fractal Alpha. So if you look at it over the last 3 years, in fiscal 23, our losses was north of 50 crores. And that came down to 44 crores and then further down to 26 and now 10 crores for the last 9 months of this year. And as I mentioned, in the first 9 months of this year for Fractal Alpha, the growth in revenue has been 51%. Gross margin was close to 70%, and it's an improvement of almost 300 bips. And profitability or the losses have come down by 50%. So it's a story of robust growth. And as we keep scaling with such high gross margins, our profitability trajectory is bound to improve and keep getting better. And we expect this trajectory to kind of keep improving and get to a place very soon where you will see profitable contribution from Fractal Alpha.
And what is the view on overall net count addition, headcount addition? Srikanth, what is the current head count? And because we are increasingly hearing of a lot of cases where AI has reduced the need for total number of people. Is that happening at Fractal Analytics?
Our headcount continues to increase, though our revenue per employee will increase. As we expand and AI takes a larger share of the work across various items, you will see that machines will do more of the job and humans will do some less of the job. Therefore, our revenue per employee is a number that you should track. Our revenues will increase, our employees will increase, but revenue per employee will also increase, which means that the share of machines taking the load increases as a fraction of our revenue.
And what is the view on R&D spending? It stands at 6.8% of the overall revenues. In the immediate term, near term, what will that spending look like?
So R&D investments for Fractal is a very important part of the way we are building the business. The reason we are so credible as an AI firm is because of the incredible work we are doing. These spends are directed either at the Fractal.ai business, which helps us in expanding our gross margins. And for example, we launched something called a Spy Evolve. It's a machine learning agent that automatically builds machine learning models. It will dramatically improve our accuracy, improve our productivity, and therefore accelerate our overall growth and profitability in the Fractal.ai segment. The second place where we're using AI R&D is in the products area, our Cogentic platform. And here, we're not trying to build a competing model for OpenAI. We use the OpenAI platform, build the ontological layer, which is based on the data inside companies, and then on top of that, build agentic workflows to reimagine every business process in that company, which is a great mode. As AI progresses, our models get better, our platform gets better. So that's second. So we expect that as we grow as a company, a fraction of the revenue that is spent on AI R&D is not going to decrease, it's actually going to increase. This, we think, is a true differentiator for Fractal, and we'll continue to invest behind AI R&D.
Well, the stock is doing well today. It's up nearly 4.5% post the numbers. In the next 6 months, do you see the need to deploy the 800 crore plus cash on your books?
Shwet?
Yeah. So we closed the year with 800 crores, and that was before the IPO. So we obviously have more cash right now, and so that gives us the optionalities for us to do the right capital allocation to drive future growth. So a part of one of the reasons for use of proceeds that when we raised around 1,000 crores of primary was to repayment of debt. So that we're going to do pretty much soon. And the R&D investment, which was the biggest use of proceeds for us, that is continuing. So, and also our cash generation itself from the business has been very robust too. So all the engines are in play or at play. And we see this gives us a lot more optionalities to see what's the best course of action for us to allocate this capital.
Thank you, gentlemen, for joining in. That's the word coming in from Fractal Analytics. Very confident that the revenue growth rate that they've seen of 20% in the first 9 months of the year will continue, or perhaps it even gets better, and the stock is up nearly 5%. Well, here is an important programming note as we slip into a break. Weight loss drugs are in vogue with rapid adoption across markets. But for investors, are weight loss drugs an attractive portfolio bet? Tune in to CNBC TV 18 on 9th of March, 3 p.m. onwards to catch the big players in the weight loss drug industry on one platform, discussing the opportunity lying ahead.
Welcome back. Not a freaky Friday, at least as of now. The Nifty is down close to 100 points. You have the Nifty Bank that's down 500 points. And the Nifty Bank is going to be the big swing factor today. If the Nifty can recover, well, the Nifty Bank will have to cut its losses from around 500 points. The good news is number of stocks advancing, way more than the number of stocks declining. Your portfolio will be feeling a little bit better because the mid-cap index is outperforming. That said, let's go across to the management of Equus. That's the next management on the show. The precision component manufacturer recently entered into defense tech manufacturing by investing a small amount for a 33% stake in Anshna Aerospace and Defense. To discuss this, we have Mr. Arvind, the chairman and CEO of the company. Hi, Mr. Arvind. Good to see you in, sir. I recall when you listed, we had a couple of chats, and you were sounding quite optimistic about business. And one notable aspect is that, a high proportion of your business comes in from exports. For the time being, just running our viewers through the three focal points we're looking at: the defense segment, what's the outlook, recent JV, growth opportunities out there, and most importantly, the impact of the geopolitical crisis on exports. So let's get to the third point, sir, first. What kind of impact have you seen on your business? Because I think 99% of your business is exports, right? Have you seen some kind of logistical issues? Have been some cancellations from your customers? Give us a broad feedback.
Yeah, thank you. Good morning. The challenge is obviously we're 100%, almost 100% exports business, and aerospace side, it's predominantly material is planned for quite a long time. 3 to 4 months material is there, and for us, the advantage is the ecosystem what we built, where our suppliers are very close within 500 meters of within the zone. That helps us in terms of incoming material perspective. obviously the exports predominantly are air-shipped, and we do see some disruptions right now because of the flight cancellations. Cargo is doing well, doing fine, especially the dedicated cargo freight for private guys are doing well, like FedEx and UPS and everything is, and DHLs are doing fine so far because we're not seeing much disruptions there. But underbelly cargo, which Emirates was a big player, Middle East guys were a big player, we see some delays in their challenges. But I think in general, it was a good part. This happened towards the end of the month where most of the cargoes would have shipped for a month-end requirements. Typically, it surged towards a month-end. And initial periods is predominantly, it takes a couple of weeks before this ramp up happens again. And we see this, to stabilize itself. And we have an option to shift from the underbelly to the dedicated cargo freights. That should help and move on with activities. So that should not be a problem. It's a very short lived in my view where we see right now, and we can readjust. On the consumer side, which gets shipment happen by sea, some of those are taking longer time to plan. That's what the customers are telling. Typically, it's X works for us. It doesn't impact our business, but our customers are taking longer time to plan and also they have to schedule to go around the Africa because the Strait of Hormuz is going to be out of function for a period of time.
It's an important point that you're making, sir, because the consumer business here, like you've been pointing out earlier as well, will be a growth driver for you because that's the one which is a lot more capacity headroom right now. You had expected, the overall business to reach about 2,000 crores by FY27 and turn profitable by end quarter of FY27 as well. So does that push those targets ahead? At least in the very near term, do we see business targets being pushed by a quarter or two?
No, not really, because consumer actually within the consumer electronics is being driven heavily for our growth. And that is not being affected by this one because that gets supplied within the Asian region. And that's not getting impacted at all. And that gets airlifted. So that's not an issue. It's a predominantly consumer toys where predominantly customer base is in the US. And that's being impacted right now. And that's more from the customer ability to take the planning perspective. So far we see. And, it's not really a revenue impact for us or production impact for us because we have visibility to continue to produce. That's not an issue.
But since you will be unable to ship those toys which are meant for exports on account of the stoppage of the Strait of Hormuz and general Middle East tensions, will you not be sitting on inventory? And if this prolongs, would you at some point need to cut back on your production?
I don't think so, because customer orders have not just because it takes typically several months for this to impact. If this is going to continue, there has to be other routes found, and there are routes in the past also. We have had these Red Sea issues. We had, all these issues. Customers have worked around it, and Cape of Good Hope, around the African Horn, they will take that route to go to US.
So then, who pays for the incremental cost of passage? If the shipments need to be rerouted, there is a cost associated with it. Who bears it?
It's customers because it's ex-works. For all our shipment is ex-works. So my job is done as soon as it leaves my factory.
Right.
As they load it.
So no impact for you, none whatsoever as things stand right now. No cancellation.
Yeah. It's just a delay which customers are working through. We have seen this before. That's what my point is. And we had issues in Panama Canal blockades, Red Sea blockages. We have seen through this.
Got it. So that's about the current geopolitical issue and, export-oriented businesses navigating through multiple, hurdles, so to say. But let's speak about the acquisition, investing 10 crore for about a third of, Anjana Aerospace and Defense. What does this do to the capabilities? What's the incremental revenue potential likely to be here? And what's the kind of timeline that we're looking at in terms of revenue recognition?
Yeah, if you really look at it, Aegis is predominantly in precision components manufacturing, and we have been very clear, and majority of our aerospace activities, commercial aerospace. And on the defense side, we were very clear we wanted to make sure that we enter at a system level. And this was an opportunity for us to partner with Axel and Aegis Defense to form this greenfield joint venture. and do focus on the UAVs. And you are seeing this in this war, how effective the UAVs have been to create pain and also the impact perspective. And India is very much interested in developing these various UAVs, and we believe there is a opportunity for us to bring the right technology partners globally and develop this, and will be the operating partner where manufacturing will happen. So it's a bit of a longer play, and we are seeding this, and as we speak, the entity is getting formed, and the TOTs are being there, and we are bidding for some of the contracts within their defense.
Right. And by when does revenue start getting accumulated, and when do you get orders?
Yeah, we should start seeing in 27, FY27 start seeing some orders, and 28 level we should be able to start seeing some revenues coming in, trickling in, somewhere around 100 crore level to start with.
Okay, 100 crore in FY28 or FY27?
Yeah, late 27, 28.
Got that. So broadly, what are the projections for FY27, Arvind, in terms of a top-line growth, and then between the two segments that you operate?
I mean, if you really look at it, we have grown last year, Q3, we grew about 38% year on year on the aerospace side, and over 150% on the consumer side. And overall, business grew over 50%, and we continue to see that kind of a momentum, 50% kind of a growth rate guidance, and 30% in aerospace growth happening in the near term. And our order book has been about $850 million in aerospace itself. And consumer customers have been very clear with respect to take the capacity of what we can deliver. Right?
Okay, so 50% revenue growth should continue. And in particularly aerospace, you're a tier 1 supplier to HAL. What are you doing to deepen that relation? What is the pipeline from HAL looking like? How you can participate in more orders?
We have been, HAL, we've been working with them on the LCA. If you see our vertical integrated capability, especially forging, machining side of it, and we are working with them to do more of that activity. Today, we do certain, pylon components for the HAL LCA, which is a fairly decent order what we had received earlier last year, and we're executing that right now. And we just delivered the first set of those pylons, as per the plan. So we are doing, and we continue to expand that relationship. And historically, we are not focused on much on the India defense, because it was just a process in which you can win the contracts. It was taking very long time. And the customers have, especially the HAL has improved that process and doing it faster, because they have a commitment to deliver LCAs to the India defense pretty steep fashion. And we believe we can be a good partner for them. And they recognize that.
All right, take that point. Thanks a lot for joining in. Always a pleasure speaking with you, Arvind. Though one wonders what the impact on working capital could be, given the sort of disruption. You are anyway at over 120 days, and you said that it will remain in this range. Do you see any downside or any extension of working capital by say 10 to 12 days? Would that be fair to say?
It's look, if it goes on for more than 5 months, so we need to start stocking more.
Got it.
That's what I would say. That's the point. Comes down to we have to place order more, and we have to more contingency planning. As I said, our ecosystem, our suppliers hold the material for our behalf most of the time. So it's not really a direct impact to us. We do more just in time with those people.
Take that point. Okay. With that, we'll move on. Let's welcome Saumil Mehta of Mirae Asset Sharekhan for a quick technical check on the market. We've seen recovery from the lows, but it hasn't been a formidable recovery. In fact, any sort of up move on the frontline index is being sold into right now. The Nifty is back below that 24,650 sort of mark. So it's off highs, but off lows as well. The mid-cap index is the one which is holding up with gains of almost 1/3%. That too is off the highs. Saumil, your quick check on the market and any stock that has excited you so far?
Good morning to everyone. We are just playing for a bounce at this point of time. We've seen a good bounce here. In some stocks, there are good rallies as well. Defense and pharma looking great. For Nifty, the trend is down because we are making low tops, low bottom formations on the weekly, monthly charts. So now the trend is down. However, on the daily charts, we've seen a good recovery. and the targets in the very short term would be 25,000 just for the bounce. I'll be looking for this downtrend in the higher time frame to continue for a target of 23,900, 23,500 levels. In the very short term, the support sectors would be pharma and defense. So these are the two sectors I'm looking forward for. Banking, I'll stay away for a little while and just play for a bounce. The two stocks which I've chosen here is, first one is PFC. PFC has just broken out of a small consolidation, taken support at 200 daily moving average. Great setup for a medium-term outlook, a positional setup. And the stop loss would be 397 for a target of 460. The second one I've chosen is from the Pharma Pack. Pharma Pack is looking great here as well. Biocon is the stock I've chosen. Biocon has taken support at some averages and the short-term averages, and a small consolidation has also broken on the upside. Momentum indicators have fresh given us a buy signal. So the stop loss would be 380 and target would be 415.
Thank you very much for now joining in. All the gains are concentrated in defense and railway names. So DCX System, Jupiter Wagons, Ircon 9% higher, Mazgao 7.5%, Bharat Dynamics 6.5%, RVNL 5%, IRFC, IREDA, IRDA up 3.5%. Paris Defense, another big mover, big volume, stock is up nearly 4%. So big gains seen in defense and railways as a segment today. Get into a break. On the other side, Manisha Gupta will join in to talk commodities. Stay tuned. Welcome back. It's a Friday, and while we've seen the Indian equity markets feel the heat of the pain in the geopolitics, there's been so much action in the world of commodities. Manisha is here to tell us more on that and even recap that since the beginning of this conflict, what's the extent of moves that we've seen in various commodities, Manisha?
Well, absolutely. You know, crude oil prices, of course, are headed for a strong week, 18% up for that one. But when you look at the metal prices, that is where the pain really seems to be coming in. The knee-jerk reaction for many of these metals was on the higher side. But by the time we are closing this week, there has been immense profit-taking across board there. So take a look at the gold prices, 2.5% decline onto that one. Silver is down 10% for this week till time. We did see $98 an ounce as well, but it's trading at 84 at this point in time. Copper prices also are down 3%. You have zinc, which is trailing by 2% for this week right now. And that pretty much is the case for other PGMs as well. So when you look at platinum, palladium, we are down by nearly 8 to 9% for those metals there. 5% down on tin as well. We did see all-time highs for tin in the month of January there. And you have aluminum, the only one actually standing tall by 4% of gains. But we have been talking about aluminum and how 8 to 10% of global aluminum production comes in from Middle East, and with the conflict there, you have seen gains come in for this one. But the other metals, let me tell you, already had war and tariff premium built into that one. Gold, for one, is headed for a first weekly decline in 5 weeks there, but we have seen $5,600 an ounce of gold in the month of January. So all that premium was already into prices. Metals did hit all-time highs, not just gold. Silver hit all-time high in the month of Jan. Copper hit all-time highs. Tin hit all-time high, and the other metals like aluminum, zinc, palladium, lead did hit 3 to 5 year highs in the month of January. So most of these metals were anyway on the overbought side of it, and is the reason you're looking at some profit taking. And then, as I said, the war premium was already baked into many of these prices. What is leading to sell-off in the many of these metals also is paying off margin elsewhere. The kind of declines that we've seen in currencies, in equities as well. So some profit from many of these metals seems to be going in that direction there. So money rotation is what we are looking at basically. And then, of course, there is strength in the US dollar index. The safe haven buying is happening there. Dollar index is trading at a 6-week highs. And then you have higher treasury yields as well, putting pressure on many of these commodities because most of them are dollar denominated. And then take a look at the US economic data. All of that has come in on the positive side. So the momentum clearly stays on the stronger side. From labor numbers to retail sales, housing data, all of that has been on the positive side. The crude oil prices at an 18-month high also seems to be triggering some inflation there. And markets believe that this inflation will lead to US Fed rate not looking at a very strong rate cuts going forward. And the US Fed may perhaps be cutting just one more time in sense of rates, and that too not in July, but perhaps in September or October, and markets are pricing in just one rate reduction is the reason you have seen a very sharp correction coming for gold and silver especially, and then of course some for base metals as well.
Indeed, that's the reason why the US 10-year bond yield went to levels of 4.14. Thank you, Manisha, for that. Get into a break. On the other side is our special segment. It's the economy. Lata discusses the changed contours for the Indian oil and gas companies with former CMD of GAIL, SK Gupta, former CMD of BPCL, Mr. Krishna Kumar.